We talked about it last week. Why do people buy Bitcoin? There's utility. And what is that utility? When the government effectively stop you from, your freedom of speech, sooner or later, they're going to grab your bank account. And so you're looking for some kind of safety.
That's a great line. That's a great line. I thank God I'm recording. I should put that right at the front.
Oh, shit.
Holy fucking shit, it's a dinosaur! Jesus Christ, what the fuck?
Welcome, ladies and gentlemen, to yet another issue of the Grey Market Talk with Nick Themistocles. How would I call you today? Portfolio manager, market maker, investor, speculator, hardcore trader, and Elliott Wave specialist, who happens to be one of my good friends, and we have regular conversations, so that's why we're posting them. And Thorsten Wegener, a retired market maker. As I always indicate, I never cared about too much whether markets went up or down, because in the long run, who knows what's going to happen. But I like to speak to people who have good ideas what might happen in the future, and that's why I'm Nick on board. Nick, thank you for being here.
You're welcome. Good to see you.
So let's start right in. I want to pick your brain. Last week's numbers were actually quite interesting. Let me not put them on the screen, but have them in front of me. What did we see? We saw PPI coming in after our last conversation, was expected with 0.2, came in with core PPI, 0.3, worse than expected. Core retail sales were expected plus 0.5, came in with 0.03, worse than expected. Retail sales, 0.6 came in, expected 0.8, worse than expected. Unemployment claims was expected at 218,000 and came in at 209,000. So a little bit lower, but as we all know, they're going to revise that with the next numbers, that it actually looked worse. They're playing this game now for quite a while. And then Empire State Manufacturing Index came in minus 20.9, was expected minus 7. And preliminary consumer sentiment came in with 76.5, was expected 77.1. If I just sum up these numbers, worse than expected in every perspective. Yeah? Inflation could be not finished off. Retail sales, the consumer, not doing as well as everybody expected. So what's your take on these numbers?
So I think that theme that we began 2 weeks ago with your retail sales chart, or Eve's retail sales chart, which I thought was, the starting point of all of this, continues. And I think that does point to there's a weakening backdrop in the economy. It's not weak enough to say that the economy is in trouble, but it's definitely weak enough to say that it's not all hunky-dory. And if you look at the GDP Now forecasts from the Atlanta Fed, they're no longer coming in with a 3 handle. They've all got a 2 handle, a 2.3, I think was the last one for Q1 of this year. And that's sort of not far above trend growth rate. So it's not a rocket anymore, in my view. The economy is not booming as it was at the end of last year. And that, spells signs of what? That says, okay, if you are super euphoric about the stock market, well, maybe you shouldn't be so super euphoric, and maybe you need to take some risk off the table. And on the inflation stuff, well, I said this before, 2 or 3%. The reality is that the amount of money printing that's been going on, the pound in your pocket, or the dollar in your pocket, or euro in your pocket, just doesn't seem to buy it as much as it used to. And they call it 2 or 3%, but it's obviously the reality is far higher. But inflation is a mixture of 2 things. One is monetary inflation. The other one is high street inflation. At the moment, there's some push and pull, and the thing that's keeping the inflation number high is the shelter, and shelter is high, but it's been creeping lower and lower and lower and lower. And shelter obviously is not something you can just turn on and off, because leases have to expire in order to renegotiate them and get this thing down. So the number that you see is somewhat misleading. I think on the monetary side, there is sign that monetary inflation is coming down. The near term, in the longer term, we know the reality with printing all of the money in order to pay for all of the debt or finance all of the debt. Longer term, you do need monetary inflation hedges, gold and Bitcoin. And on the economy side, I think, it's not as strong as everyone thought it was.
I thought it was interesting, especially 2 weeks ago with durable good numbers came also worse than expected. Yeah. How does that always go together in a scenario where you think, okay, PPI comes in hotter than expected, but they are not buying durable goods. So that is worse than expected, almost makes one scratch one's head and think, is the ugly word stagflation a topic again? Because I have this rule of thumb, yeah. PPI filters into the CPI with a lag of about 6 months and then to 2/3. So by the time it shows up in the CPI and the inflation data, consumer inflation, everybody's forgotten what happened 6 months ago. So if I put all these things together and then say, okay, the industrial complex is not investing in heavy durable goods, long-term investments, but prices are still going up while the GDP, well, it's still positive, it's still nice, don't get me wrong. I think German finance minister and business minister would kill for US growth rates.
Sure.
But obviously we are here to listen to what might happen in the future. Does that make sense? Is there stagflation? Is that a topic or is it not?
When you look at your quad chart, your business cycle thing, you're saying, okay, my fear is that we're going to go below the bottom, the horizontal line, and growth is going to start to come down. And the scenario that we've been talking about for the last almost year is that, frankly, neither the central bank officials or the government officials can afford for growth to falter. They can't allow this thing to, because so on the basis that we know that they have to keep things moving, it just means that when there is a hint of either stagflation or deflation, that we know that the solution that they're going to adopt is just, more debt, more sort of Inflation Reduction Act, more sort of money in the pocket, more this, more that. And ultimately, that just means devaluing, the purchasing power of the cash that you've got, because, there is no limit to what these guys are going to do, right? And on the inflation side, well, that's a spillover of all of this thing. Longer term, if you continue to do that, it's going to take more debt to deliver less growth. And ultimately, this stuff has to be financed. And the only way you can finance it without crowding out the system is if you continue to print money. So, until somebody says, okay, that's enough and we're going to restructure the system, because the financial system today isn't as stable as it was before. And that's why we're all looking for alternatives.
Yeah, well, I've actually got a fantastic chart. You might have got that as a meme as well. Higher for longer. Nice chart with, I think it's Greta Thunberg here. My former colleague from Bear Stearns, Jesse Felder, he wrote an article, I think it was 2 or 3 weeks ago, where he said, well, we're not longer priced for Goldilocks scenario, we're priced for Platinum Locks scenario. And that stuck in the back of my head to think, okay, fine. Look at the market we have at the moment. And these little pinpricks coming in, well, it's clearly the time to be a little bit more cautious. And especially then we're already slipped into the interesting slides. Barron's now title picture, bet on the bulls. We've seen quite a few of that recently. Yeah, The Economist came out, German newspapers are full of it at the beginning. The Focus Money came out with it's a weekly in Germany, said if you're not getting rich now, you'll never get rich.
Yeah, absolutely. And I mean, where does that remind you of? I mean, it reminds you of 2023 when all of the the major investment banks or the major advisors were coming out saying, we're going to break 3,000 on the S&P on the downside. It's all going to ratchet. And this week, I heard or I saw something come across the screen some investment bank basically said, oh, you don't need to worry until the S&P is something like 6 or 6,500. So this is a classic pro-cyclical news story, pro-cyclical advisor. You know, I ignore all of these people because they're wrong on the downside, they're wrong on the upside. But you're right, they do make very, very good, you know, sort of tops of charts and bottoms of charts sometimes. And, you know, you just don't want to get caught out on that.
Well, that definitely goes in the collection. Like one chart, and we discussed that in the green room earlier already, how to interpret that. But I thought it was very interesting. What does it show us? The weight of high momentum stocks in US equity markets is at all-time highs. So let's pick that apart, how we thought it could be managed from Piper Sandler portfolio strategy. So you have the Magnificent Seven, obviously, and nobody would doubt that they are momentum stocks, correct? They made good performance, and we like momentum and relative strength. Murad's monthly is exactly looking into these features, and it gives us really fantastic predictions. So this chart, in my mind, is not to rubbish what's going at the moment. Oh, momentum stocks are at an all-time high. The market has to crash. What it simply shows us is that the concentration, the cluster risk, is extremely high. If over 30% of the market is in high momentum stocks, what always people tend to forget, momentum is a bitch. It works both ways. Yeah, when market goes up, that's what we're seeing at the moment. Yeah, people talking about crack up boom and new all-time highs. Yes, we are on this side. However, if momentum flicks over, and we are obviously investigating all the time, what could the reasons to be that? It could work both ways, and that would open up, well, Pandora's box on the downside. God, with all these Greek analogies we're bringing in, Nick, you're really having positive impact on me. Do you agree with me that that would be the right interpretation, or do you have something to add?
No, I think that's a fair point. You know, the idea, though, I've never sort of particularly looked at this, you know, signal, if you like. So I just don't know how well it describes a message to say, therefore, the next step must be, because, you know, there are various sort of points along that sort of that sort of straight line going up where you could say, oh, it looks very high and therefore it could reverse. So it tells me the status of the market. It doesn't tell me that that things might be turning around. But the other thing that we discussed in the green room is, well, you know, what is there that's out there that tells you if the market is turning around? And one of the things that have kind of struck me in the last few weeks is the ratio of stocks versus precious metals and stocks versus energy. So if you look at, I don't know, S&P versus XLE, yeah, very good chart. Or if you look at S&P versus gold, then it tells you that all is not well with, you know, it's a warning sign for me. And I prefer that kind of a signal than the previous chart. But your chart here, which I'll let you describe, I think confirms what I'm looking at.
Well, first of all, it's a logarithmic chart. I like to use logarithmic charts, especially I'm not, we spoke about that last time. I'm not defending cryptos and stuff like that. But if you have cryptos on a regular chart, you have this huge blow off top. And then you simply put it into a logarithmic chart and suddenly it looks far more subdued, because what a lot of, especially the retailers out there, forget, if a stock goes from 1 to 2, it made 100%. If it goes from 2 to 4, it made 100%. But it goes from 2 to 3, it only made 50%. So portfolio managers out there, the so-called smart money, they are not buying because a stock went up by 10% or went down by 10%. They make the decisions on percentage movements. And that's what is represented in the logarithmic chart. So having said all that, I should have made the trend line more prominent. I went back to basics. I said, okay, let's look beginning of 24. Do we see a temporary low? And we did see one. So I took that as the anchor point for my trend line. And I simply extended it on the closing price basis, and it beautifully forms an uptrend, which now on Friday on closing basis for the first time has been broken under high turnover. don't overinterpret the turnover to everybody who's listening to us. We had OPEX, so there's always a lot of stuff going on. However, I'm not the only one who looks at charts like this, and we all love a good trend. We like trends if you can see them in the market. If you play against them, you usually lose money. If you go with them, at least you're not making too many mistakes in there. But we've broken it for the first time. So that is the question now. Because it was option expiration, will the market recover next week, or will people say, the typical scenario would be, from a trading perspective, market ticks up again over this trend line, closes there, all shorties are going out again, and then we see a hit for whatever reason. And then it extends to the downside. If we break trends since the beginning of this year, the market had a nice performance, especially our Magnificent Seven. It could be a warning signal, at least something to have an eye on.
Indeed. I mean, all you could do is gather the evidence, and one of these things will trigger. As I said before, I think, buying the market at these levels isn't necessarily the smartest thing. And perhaps there are better markets to buy overseas. And I think if you look at even the S&P, I'm not sure if I've got it up here, the S&P versus DAX, even the DAX is better than the S&P, I think, these days. So, all of these things suggest that perhaps the S&P is a bit tired, and you should look elsewhere. If you want to put money away, maybe the US market is not the right place to be.
Well, everybody's talking about that the ECB will be the first one to reduce the interest rates, right?
Well, rightly so. I mean, they were wrong to sort of follow the US in the first place. They have two things to look at. They have inflation to look at, which they didn't understand what caused it. So the expansion of the money supply caused the inflation. They see the inflation coming down, but they say, oh, it's not quite there, and the Americans are not ready to cut. But the economy is awful. And they've got much bigger problems in real estate than the US have. So in this respect, they shouldn't be looking over to America. They should just be acting independently here and making a decision to say, well, our economy is more dependent on interest rates than the US economy, and we need to get some kind of recovery. At the moment, they should not be sort of hesitating. They do need to cut rates far faster than the Americans.
You could have actually called the real estate top in Germany. You know why? The moment they started discussing in parliament to make every homeowner, every property owner to revalue their properties, to extract more taxes from them, that was pretty much the peak.
Yeah, that's always a good sign, isn't it?
And we all had to go through the bloody reassessment. You had to sit with your tax advisor. That was really absolutely greed. The government wants more of your money. What have they managed to do? Well, they picked the top. Absolutely. I hope it will explode in their faces. Anyway, so yes, talking about the valuation of the market. I saw a very interesting video from Game of Trades, the go-to channel for entertaining news, and they looked into the valuation of the market. Is the market actually really extremely extended on the valuation side? And the argument always goes like this: can we compare to 2000 or something ridiculous like that? No, because in 2000 all these companies were had valuations which were based on a newly created term, eyeballs. How many people did they see on the internet? And yes, as long as they can attract customers, profits will come later. Okay. So these companies we have now, especially the Magnificent Seven, they're making hard, cold cash. They're good companies. They have good products. They make big revenues. They make a lot of money. They make more P&L than some sovereign state nation has in GDP. So all good. And the Schiller PE ratio is one of these valuation methods, which shifts a little bit into the futures, flattens the earnings over a 10-year period. And as we can see here on the chart, we are far away from having the valuations in 2000. We're not cheap with a 34.22 PE ratio, but we're also not overextended. So I thought, okay, fine. Let's go back one step and simply look at sales ratios, because we've talked about that quite a lot here, that especially Nvidia is now has valuations of 33 or 34 times their sales. And it was compared to Cisco, which had 10 at the 2000 internet bubble. And in these terms, this chart only goes back, unfortunately, till, well, that's 2001. And I couldn't find the data on TradingView either. So it could be that there's a huge spike in the 2099 on the left side. So we leave that aside for a moment. But if I look at just the data I have in here, corrected for the Corona spike, with prices correcting by 30%, which explained the high spike in S&P 500 price to sales ratios. We are now at very high or elevated levels. If I just look how companies are evaluated in terms to how much products they sell. We're not looking at earnings, we're not looking at costs, we're just looking at what is coming through the door compared to the valuation these companies have. And that actually, well, I think matches nicely what we discussed so far, in which regime we are, especially how we started the show, with the anecdotal numbers from last week about PPI, consumer spending, and industrial production.
Yeah, and if you look at, there's one more metric which is related to the Schiller, which I look at more regularly than just pure Schiller, is the excess Cape yield. And what that effectively shows is the returns of stocks effectively over bonds. So currently the excess Cape yield is around 1.5%, maybe slightly less. And what that means is if you buy stocks versus if you hold treasuries, you're going to earn over roughly an 8 to 10 year period around 1.5% more holding stocks than you would do in fixed income. And you could argue, well, hang on a minute, what's the point of taking all of that risk for just an excess of 1.5%? And the argument that I gave last year was, when the number was equally low, was that I believe that the returns for the next few years are going to be front loaded. So we're going to see sort of bigger returns in the stock markets. But then for the remaining time of the 8 to 10 years, let's just say from, in 3 years' time or 2 years' time, you're going to start to get negative returns from equities. So, the gap that you're getting for risky assets versus risk-free assets, argue whether they're really risk-free, is fairly low these days. And that just puts a lot of pressure on companies because, you have a Schiller PE of 34%. You need this company to grow by 30%, or these companies to grow their earnings like that. And obviously that's a big ask. And not many companies are growing that quickly. And that's the kind of the real kind of valuation issue. I don't mind companies having a high PE if they're growing fast, so if they're growing quickly, but they're not all of them.
Yeah, no, I'm with you on that. We see it in the CNN Fear and Greed Index. Slight changes to a week ago. We were still greedy at 66, so greed has gone up again. We're at 70 at the moment, and we are still in this territory. We have seen new all-time highs. We have seen our little trend break there. We have seen numbers which could indicate that we might stay higher for longer. So yeah, I think act accordingly. And as you just mentioned, all these high value companies, which have these huge, fantastic growth numbers, which justify the valuations they actually see. We've seen Adobe, I think, came last week with numbers that were a little bit disappointing. Stock was immediately slaughtered. So they have to provide better and better numbers
Absolutely
in the future, which is also makes the case for that volatility on absolute levels is far too low at these the current situation we are seeing.
Sure.
Anyway, let's start on a positive note. The absurdity of the week, as you might have heard, the German national football team has two jerseys. Yeah, the traditional white jersey, which is when they're playing at home, and the away jersey, which used to be black in the past or green in the past. And now Adidas, the provider, came out with a new design for their away shirts, and it's some purple pink shirt, which they are going to wear for the next, what's the next big thing? It's the European Cup.
I'm not a football fan. It's probably
Yeah, I
means we
mean,
lose
me
half of
neither.
our
Anyway,
subscribers. But
obviously
yeah.
the meme boys had a lot of fun with it, and the fantastic thing is the Bundesdeutsche National Elf is the 11, yeah, which sounds fantastically with the elves. So they call it the Bundesdeutsche National Elves. I don't want to complain about their pink shirts or pink jerseys because Nick and I remember quite well. We evil traders and investment bankers actually started that bloody trend. Every time when we had expiration day, especially the big expiration, the triple witches at the time, which are now quadruple witches, on a Thursday, I don't know who started this thing, but more and more colleagues showed up on a Thursday in the bank with pink shirts. We were all wearing one. If you would have entered the trading floor at around expiration time, you would have seen a bunch of hairy dudes, mostly with pink shirts on the trading floor. So yeah, finally it took the national elves only 30 years to catch up with it, but they're finally there. And let's hope it's as good a prediction for them as it used to be for us, because I cannot remember that ever anything went wrong when all the boys around you were sitting there with pink shirts, Nick. Any other experience on your side?
Well, it was actually, I mean, I was saying earlier that I almost wore a pink shirt today because for me, a pink shirt is pretty normal for a Brit. But I remember the days where if you did come in with a yellow shirt, then the odds are you probably would be sleeveless by the time you went home. So it was not yellow shirts didn't go down too well amongst the traders.
I have a fantastic story for that. You know Adi. Adi, I had him straight from university when I was working in London. One of the brightest chaps I've ever met. He's obviously now a multi-gazillionaire living in Dubai. Yeah? And I sent him to Düsseldorf to HQ to, well, mingle with the guys, know the colleagues over there. And I got this random email one day and said, all these German guys, they wear a lot of brown, Thorsten, aren't they? And I said, no, explain it to me. He said, well, there are a lot of guys with brown suits and brown shoes. And one guy wears a brown suit with brown shoes, a brown shirt, and a brown tie. And then he had in brackets, he looks like a biscuit. So yeah,
white socks. You forgot the white socks, though. Obviously, that was very.
Yeah, well, let's put
very
it that
popular over
way.
here.
But even though it
will
sounds a
not
bit
say
like a
anymore.
humble brag, we were always very nicely dressed in London, weren't we? You didn't see these completely mishaps. Everybody knew what an investment banker or a trader or somebody
Sure.
was supposed to look like. Anyway,
Good on
on
you.
this positive note, in the absurdity of the week, I like to finish our show for today. Thank you very much, Nick. So everybody who is watching us, this is obviously not investment advice, but if you've done the fantastic trade I advertised at the beginning of January, just check the backlog. We had a straddle on for cheap volatility. That's now good in the money. Yeah. Has nice returns. Maybe now is the time to at least hedge your delta, if you know what I'm talking about a little bit, and lock in the profits. I'm teaching this evening to my students. I call it my house money approach. What to do in a case like that. And that would be, well, my analysis for the week. Any famous last words, Nick?
I hope I can turn up to the talk tonight. Sounds fascinating.
I shall be looking forward to see you there. Ladies and gentlemen, it was a pleasure to see you, and like, subscribe, and share, and we hopefully see you next week, Sunday. Bye-bye.
Bye-bye.